Did you know that if you have a common age-related condition, severe arthritis, hearing loss, or trouble walking, the CRA might owe you up to 10 years of back pay tax refunds worth more than $15,000? Not a rumor. Not a scam. A real rule sitting in the Income Tax Act right now, and most seniors have never even heard of it. I'm John A.J. On this channel, we break down real CRA and Service Canada rules to get you every single dollar you're owed. If you haven't hit that subscribe button yet, do it right now so you never miss a payout update. Today, I'm walking you through CRA Form T2201, the Disability Tax Credit Certificate, and the exact part of that application that lets the Canada Revenue Agency go back and recalculate your past tax years without you having to file 10 separate paper requests by hand. By the time we're done, you'll know exactly what this credit is worth, who actually qualifies, and the step-by-step process to get your claim moving this week. Part 1. What is the Disability Tax Credit? Let's clear up the biggest misunderstanding first, because it's the reason so many seniors never even apply. When people hear disability tax credit, they picture someone in a wheelchair, and they think, that's not me, I can still get around fine. That thinking costs Canadian seniors thousands of dollars every single year. The Disability Tax Credit, or DTC, is a non-refundable tax credit for anyone with a severe and prolonged impairment in physical or mental functions. Prolonged means it's lasted, or is expected to last, at least 12 months. And impairment covers a lot more ground than most people assume. It includes difficulty walking, hearing loss, trouble dressing yourself, trouble with memory or mental functions, vision problems, and issues with bowel or bladder control. If you're 72 years old and it takes you noticeably longer than it used just to walk from your car to the front door, or if you've been struggling to follow conversations at the dinner table because your hearing has declined, that's exactly the kind of thing this credit was built for. What is it worth? Here's where it gets real. The disability tax credit is generally worth somewhere between $1,500 and $2,000 or more per year once you combine the federal credit with your provincial credit. For 2026, the federal base amount alone works out to roughly $1,400 to $1,500 in tax savings a year, and provinces add their own amount on top of that, which varies depending on where you live. In Ontario, for example, the combined federal and provincial savings can run over $2,000 a year for an adult claimant. Now stop and do that math with me for a second. $2,000 a year, sitting unclaimed, for a condition you may have already had for 5, 6, 7 years. That's not a small oversight. That's real money that should have come back to you at tax time year after year, and instead it just didn't. How do they get it? Getting the annual credit going forward starts with one form. Form T2201, the Disability Tax Credit Certificate. You can download it directly from canada.ca, or you can start the application digitally through your CRA My account under the Benefits and Credits section. There are 2 parts to it. Part A is your information. You fill that out yourself, or a family member fills it out on your behalf. Part B is the medical part, and that has to be completed and certified by a qualified medical practitioner. Your family doctor, a nurse practitioner, an audiologist for hearing claims, an optometrist for vision claims, whoever is treating the specific condition. Now I know what some of you are thinking watching this right now. John, this sounds like it's going to reduce my GIS or mess with my other benefits. I hear that concern constantly, and I want to be straight with you. The disability tax credit is a tax credit, not income. Claiming it does not add to your taxable income, and it does not get counted against your guaranteed income supplement. If anything, it can only help your overall tax position, never hurt it. And if you're sitting there thinking, why didn't my accountant ever mention this to me? You're not alone. A lot of accountants only ask about the DTC if you bring it up first, because they're focused on this year's return, not digging through your medical history from a decade ago. That's exactly why we're covering it here. Part 2, the 10-year retroactive refund rule. Here's the part of this that turns a modest annual credit into a genuinely life-changing lump sum. When your doctor fills out Part B of Form T2201, they don't just check a box saying, yes, this person qualifies today. They're asked to state when your impairment actually began. If your doctor writes down that your hearing loss, or your mobility issue, or your memory difficulties started back in 2018 or 2016, or even earlier, the CRA doesn't just start your credit from this year forward. The Canada Revenue Agency is legally allowed to go back and reassess up to 10 previous tax years to reflect that. What is it worth? This is where the number people can't believe comes in. If you take that $1,500 to $2,000 annual value and multiply it out across 10 years, you're looking at a potential lump sum refund somewhere in the range of $15,000 to $20,000, deposited to you at once the CRA finishes reassessing those returns. Picture a 74-year-old widow in Nova Scotia who's had worsening arthritis in her hands and hips since around 2017. She never applied because she assumed the DTC was only for younger people with visible disabilities. Once her doctor confirms 2017 as the start date and the CRA works through the paperwork, she could be looking at a 5-figure retroactive refund checkway, plus roughly $2,000 a year going forward from here. I want to be fair with you here, because I'm not in the business of promising numbers I can't back up. The exact size of your refund depends on how much income tax you actually paid in each of those retroactive years, which province you live in, and how many years your doctor confirms you are eligible for. If you had very little taxable income in some of those years, the credit for that specific year will be smaller because a non-refundable credit can only reduce tax you actually owed. But for most seniors who worked and paid tax through their 60s and into retirement, this adds up to real money, and it's worth finding out your number. How do they get it? This is the crucial part, so pay close attention. When you're completing your application, whether on paper or through CRA My Account online, there is a section where you formally request that the CRA reassess your prior eligible tax years, going back as far as your doctor's stated start date allows, up to the 10-year maximum. When you complete this correctly at the time of your original application, the CRA can process the retroactive adjustment as part of your approval, instead of you having to go back and file a separate the first adjustment request, Form 10th1 adjount, for every single one of those 10 years by hand. That one step is what saves you an enormous amount of paperwork, and it's the single most commonly missed detail on this entire form. Let's address the skeptic in the room, because I know some of you are wondering, is this actually CRA approved, or is this some workaround? This is not a loophole. This is written directly into how the Disability Tax Credit Program operates. The CRA has stated plainly that once your T2201 is approved with a retroactive start date, prior tax years can be reassessed for refunds. This is standard CRA process, used every day for thousands of Canadians. You are not gaming the system. You are simply claiming a credit that was always yours, and that most people never knew to ask for. Part 3. What if you don't pay high taxes? The spouse transfer rule now. Some of you watching this are on a fixed, modest income, and you're thinking, John, I barely pay any tax as it is, so what good does a tax credit do me? This is exactly why the next rule matters, and it's one of the most overlooked parts of the entire disability tax credit program. What is it? If you qualify for the disability tax credit, but you don't have enough tax payable to use the full value of the credit yourself, the unused portion doesn't just disappear. It can be transferred to a supporting family member, most commonly a spouse or common law partner, but it can also go to an adult child, a grandchild, or another relative who provides you with financial support. That family member then uses the unused amount to reduce their own taxes. What is it worth? Think about a retired couple in British Columbia. She has significant hearing loss and qualifies for the DTC, but her income is low enough that she owes very little tax, so claiming the credit herself only saves her a small amount. Her husband, on the other hand, still has taxable pension and investment income. Because he financially supports her, the unused portion of her disability tax credit can transfer over to his return, and that can mean an extra $1,000 to $2,000 back in his pocket every single year, plus his own share of that 10-year retroactive lump sum if her condition goes back far enough. How do they get it? The transfer is handled directly on the tax return using the same approved T2201 certificate. There's no separate application needed. When the supporting spouse or family member files their return, they claim the transferred amount on the appropriate line for the disability amount transferred from a dependent. If you're not comfortable doing this yourself, this is a very reasonable thing to bring to a tax preparer once your T2201 is approved, specifically asking them to apply the transfer for you. I want to pause here because this is where I see the most seniors talk themselves out of applying. They think, I don't pay much tax, so this isn't for me. If that's you, please don't skip this. The spouse and family transfer rule exists specifically for your situation. Low income doesn't disqualify the household from benefiting. It just changes who ends up receiving the refund. Part 4, the step-by-step application process. Let's make this simple and actionable, because knowing about a benefit doesn't help you if you don't take the next step. Step 1, get the form. Go to canada.ca and download the current version of Form T2201, the Disability Tax Credit Certificate, or start the digital version through your CRA My account under Benefits and Credits. This matters more than it used to. The CRA has been tightening its rules on which paper versions it will accept, so make sure you're using the current version directly from the CRA website rather than an old saved copy sitting in a drawer. Step 2. Get Part B completed by your medical practitioner. Book an appointment with your family doctor, nurse practitioner, or the relevant specialist, an audiologist for hearing, an optometrist for vision, and so on. Ask them directly to fill out Part B and to include the year your impairment first began, as far back as they can reasonably confirm. This start date is what unlocks your retroactive years, so don't let this appointment feel rushed. Step 3. Request the retroactive reassessment. When you or your doctor complete the application, make sure the section requesting reassessment of prior tax years is filled in, so the CRA applies your approval backward to the appropriate past returns instead of only going forward from today. This is the step that turns an ordinary annual credit into a full 10-year lump sum refund. Once it's submitted, expect the CRA to take anywhere from a few weeks to a couple of months to review it. They may contact your doctor directly if they need more detail about how your condition affects your daily life, so don't panic if there's a follow-up letter. That's a normal part of the process, not a rejection. Here's the honest truth I want to leave you with before we wrap up. Thousands of Canadian seniors miss out on this every single year, and it's almost never because they don't qualify. It's because they assumed disability meant something far more severe than what actually applies to them. Your doctor fills out forms like this regularly. It is not a burden, it is not awkward, and it is not something you need to be embarrassed to ask for. If arthritis has slowed down your hands, if your hearing aid isn't cutting it anymore, if walking to the mailbox takes real effort compared to a few years ago, that is worth having this conversation with your doctor about. So here's your one action step from today's video. Book an appointment with your doctor this week and ask them, specifically, to complete Part B of CRA Form T2201, including the date your condition began. That single conversation is what opens the door to a credit worth up to $2,000 a year and potentially a lump sum refund worth $15,000 to $20,000 or more once the CRA reassesses your past 10 years. If this video helped you understand something the CRA never mailed you a plain English explanation of, do me a favor and share it with another senior in your life. A neighbor, a sibling, a friend from church, anyone who might be sitting on years of unclaimed refund without knowing it. Drop a comment below and let me know what province you're writing in from. I read every single one. And if you haven't subscribed yet, this is exactly the kind of update I cover every week. Real CRA rules. Real Service Canada changes. Explain the way they should have been explained to you the first time. Hit subscribe, and I'll see you in the next one.